So, we are currently navigating a market that is testing the patience of even the most seasoned investors, with the FI's outflows hitting record levels and the global macros keeping shift in the Nifty in a tight range. The big question on every investor's mind today is what is the next move? So, to help us decode the data and find the right signal in the noise, I'm joined today by a titan of institutional space, Mr. Rahul Arora, CEO of Ashika Institutional Equities. Welcome, sir. How are you doing?
Hi, Ashmi. Thank you so much for having me on your show. I'm doing well. I hope you're doing well as well.
Yes, sir. Thank you so much. It's an absolute pleasure to have you here. Currently, sir, if we see in India, that India has already witnessed a series of events, be it from earnings season to budget, and currently the ongoing Trump drama. I mean, the global uncertainties in the West Asia. So, do you believe that market volatility is likely to stabilize from here, or should the investors be more prepared for more turbulence ahead? And how should investor position their portfolios during such uncertain phases?
So I think actually this is going to be a very testing year for the markets. I think right up to the midterm elections in the US, which are a little over 6, 7 months away, I don't think geopolitics as a concern is going to recede. While there is a temporary ceasefire underway as we speak, but the war has been on for over a month now, and there is going to be collateral damage that is going to happen on economic parameters as well as on corporate earnings. Now, these are going to show up necessarily, not entirely in the Q4 results that we're going to see in a few days from now. The first evidences of it will be certainly seen, but it'll also obviously trickle into the Q1 results. So you will have a Q4, Q1 impact. You're also going into a monsoon in a couple of months. We'll have to see how that pans out. It's looking like a fairly hot summer in India. So what kind of, climate impact is that likely to have on crops and inflation as a result? So you're looking at a lot of factors at play right now. My own sense is, Yashvi, that the market would have already revised their numbers downwards. I don't think they'll have a complete grip on what the corporate earnings are likely to be for FY27. But it's safe to assume that if, say, people started the year at 16, 18%, they would have probably cut down those numbers by 5, 7% already. And maybe there is a further downside risk as well. The RBI has held rates. Before the war started, there was one school of thought that there could have been a potential 25 bips rate cut. So I think for the moment, it's safe to say that interest rate cuts are well and truly behind us. While valuations, I think, are starting to look reasonable, there are still some pockets of the market which can get a little more lucrative, but the market never prices itself to perfection. So I'm not here sitting telling you that the war is over and this is the best time to buy. I'm no pundit. Nobody can predict that. But yes, obviously a Nifty that was nearly at 27,000 almost came down to 22,000. So you had a 5,000 point correction on the Nifty. So obviously prices on a relative basis are looking far more attractive. To that extent, I'd say yes, you could start nibbling in. But to your question on how should one position their portfolio, it all depends, Yashmi, on where you are in life. What is your age? What is your marital status? How close to retirement you are? What you need the funds for? There are lots of variables that go into, building a portfolio. But I would say that, at a time like this, when there is so much economic and geopolitical uncertainty, the exposure to fixed income and debt should go up for a year like this. So I would say that it's not a bad idea to have about 10-15% of your investments in fixed income or government-linked securities. You could probably have another 10-15%, in precious metals. Keep it like, say, for long term. So you're talking about maybe about 25-30% of your portfolio being between fixed income, government securities, and precious metals. You're left with about 70%. If you do have that much cash and you can put in about 10% in real estate, go for it. And I would still say that you could be 55-60% in equities, maybe even 65 if your risk appetite allows it. So I think for the next 6 months, this would broadly be the way I would construct my portfolio. But like I said, I don't think anyone has the answers, despite valuations seeming reasonable. Has the market bottomed out? I'm not sure, but this will be a year that you would, at best, I think the best mantra would be cautious optimism and sort of tread with some amount of trepidation.
Okay, so, where do you see the Nifty and Sensex heading by the year end?
I don't know by the year end, Yashvi, but if there is, like I said, I don't think this is the end of geopolitics. But the way I look at it is, if you assume that the Nifty had bottomed out at 22,000.
Hmm.
I have gone on record to say in the past as well that the Nifty between the low of this year and Diwali of 2027 will potentially return between 40 to 50%. So if indeed the low was 22,000, I would not be surprised to see the Nifty at say 33 to 35,000 by next Diwali, which is a very big return on the index. But to specifically say where it will be at the end of this year is a little more difficult because I think if the world normalizes post the US midterm elections, the drama cools off, we get back into a situation where the rupee heads back to say sub 90, around 88, 90. You have a situation where crude goes back to say, 70 to $80. The CAD is back in favor. If all those things happen, then you're probably looking at FY28 earnings growth being what FY27 was expected to be. And then the market will start pricing that in, say, as we, get into the back end of this calendar year. So I'm relatively more optimistic from the stock market perspective for the next calendar year as opposed to the current calendar year, which is basically FY28 as opposed to FY27. But for this year, like I said, I think it'll be very volatile and choppy, and it's too difficult to predict what the index level will be at the end of this year. But I'm relatively sanguine about the fact that if the bottom has been made, then the index can potentially return 40-50% between now and next Diwali.
There are many data and posts suggesting that diversified portfolios tend to deliver better returns over the long term. Specifically, we see around 10 to 20 years. So, however, there is also a concern around over diversification diluting the returns. So, in your view, how should an investor strike the right balance? What is an ideal diversification strategy so that it does not become over diversified?
So when you're talking about diversification, Yashvi, are we talking about asset class diversification or market cap diversification within equities?
Market cap diversification in the equities.
So, so I think Yashvi, in a year like this, which say personally for me, which I'm expecting to be a bit volatile and a bit tumultuous, my skew would probably be more towards large caps. So if I had say 100 rupees to invest, my tilt could be as high as 70, 75 rupees towards the large caps and the balance 25, 30 rupees towards mid and small caps. And even within mid and small caps, I would probably aim at the higher end of the mid caps and the higher end of the small caps. And even if of that balance 20, 25%, let's say 25, 30%, if I say 70, 75% large cap, I'd say about 15, 20% of that would be mid cap. So you're probably talking about a portfolio that is about 90, 95% large cap and mid cap, and maybe about 10 to 15% small cap. That's the way I would approach it. This obviously takes a dramatic U-turn in a phase where the market is on the ascendancy. So obviously, if the market is going up, then my exposure towards mid and small caps may be closer to say 60%, and my large cap, which is say 70, 75% today, drops down to say 40, 45%. That's the way I would look at it. So in a market that's going down, I would skew it more towards the large caps, the top 100 companies, and in a market that's trending upwards, I would say you reverse it, have maybe 60% in the mid and small caps, and maybe about 40% in the large caps.
We have often seen that retail investor often gets attracted towards the multi-bagger opportunities. But when it comes to identifying those opportunities, many investors tend to associate with the low price stocks, that is like 1 or 2 rupees share. So, in your view, how should retail investor correctly approach multi-bagger investing, and what are the key factors that they should see instead of the just the stock prices?
So Yashmi, I'm no expert on penny stocks. These are very dangerous to get into because a lot of these may be managed because the float and the liquidity of these stocks will be very, very low. Promoters could have vested interests in managing these stocks along with, people who get into that kind of stuff. But that's not an area of the market I've either looked at or have an expertise in. So if you look at just say, the top 250 or 500 companies in India, I think if you're looking at finding multi-baggers, those multi-baggers would probably lie between stock number 250 to stock number 500. I don't think there is any stock in 1 to 250 where even today, as I speak to you, someone will say will double in the next 1 year. That I don't think we are in that age where, anyone will thumb the table and say कि ये stock अगले 1 साल में double हो जाएगा. Multi-bagger तो दूर की बात है. I'm not even talking about 3, 4, 5x. So there will be opportunities. I think there probably are 2-bagger, 3 multi-bagger ideas, but I would not venture into finding them at the absolute value of a share price, since that was your framed question at 1 rupees, 2 rupees, 5 rupees, 10 rupees. If that happens to be the share price of a company that is, say, trading between number 250 and 500 on the index, then so be it. But I don't think there will be. But if it happens to be, so be it. But I'm not going to look at finding multi-baggers basis that, because that to me makes no sense. Like I said, let's say you get into a 5 rupee stock theoretically, and after 2 weeks the war resumes, and that 5 rupee stock goes down to 2 rupees. Now just imagine the damage. You've lost 3 rupees on a 5 rupee stock, which is 60%. And then there will be no exit as well. So in the trap of going for multi-bagger ideas on absolute rupee value of stocks could be a very dangerous ploy. But that being said, like I said, I think there are enough and more multi-bagger opportunities, or maybe not multi-bagger, maybe stocks that will probably give you 75 to 150% kind of returns. But like I said, those ideas would probably be more between stock number 250 to number 500. And of course, even below that, I'm not saying there are not good companies below the 500th company in India, but then, from an institutional investor perspective, the liquidity of that becomes very low. And I must confess that I don't have an expertise in tracking too many stocks beyond the top 500 because of liquidity and market cap constraints. But even within that 250 to 500, I think there are enough and more opportunities in a lot of sunrise sectors. There may be stocks in defense, there may be stocks in chemicals, there may be stocks in BFSI, new age companies. A lot of these that would probably be floating in that 250 to 500 range, which could, like I said, return you anywhere between 75 to 150% over the next 1 year. You just have to make a little effort to find them, but they're there.
Yeah, even the new Gen Zs are getting more attracted towards these kind of multi-baggers and all. Okay, so for the young investors who are in their early 20s, who have the advantage of the time, that is the power of compounding. So, what could be the ideal approach to long-term investing? Which sectors should they focus for the next 10 to 20 years, and how they can allocate into the portfolio different assets to build a sustainable wealth?
So I look at it two ways, actually. I think if finance and stock markets is your career, then you can look at a mix of, going through a systematic route as well as a direct route. If you're someone who's, meeting managements, listening to conference calls, tracking annual reports, and are in the profession, then obviously direct exposure to equities is completely fine. But I would still say supplement that with a systematic investment plan of investing through, the already available vehicles through mutual funds, insurance companies, AIF, PMSs, and so on and so forth. Passive investing is going to pick up in a very big way in India. It already is making a fairly big, dent. But I think that should be a mixture for professional in the financial services sector. For somebody who's not in financial services, say working, in the auto sector, consumer sector, IT sector, but has that disposable income to invest and is in their early 20s, as you said, in terms of an age profile, I would say completely do it through the regulated route. That mutual funds should be the direct route that you basically follow. SIPs, you're also allowed to invest $250,000 under the direct route through the government of India and overseas funds. There are a lot of funds in India, mutual funds that have launched overseas products as well. So you could look at diversifying through that as well. So, instead of buying a Netflix or a Google or a Microsoft directly, or a Tesla or an Nvidia, you do have vehicles in India that are making a sort of basket of these stocks, a good aggregate and conglomerate of them, where you can look to allocate some exposure to that for exposure to overseas assets as well. So that's how I would look at it. A financial services professional, I would say, could be a mix of direct and indirect. But if you're not somebody who's directly in the financial services sector, and this is something that you're doing to get an extra income from an investment standpoint, then I would say trust the investment professional to do it, and look at doing it through vehicles, like I said, whether you are doing it through a mutual fund, insurance, AIF, PMS, or overseas routes, whatever that is. But that would be the preferred mode. It's a mantra that I follow till today. It's a mixture of direct and indirect. But even being in the profession today, I do have a bulk of my investments that go through the regulated mutual fund and insurance route.
Okay. So, from a retail investor's perspective, how can one identify these early signs of potential market downturn or a crash? And once the market shifts, starts falling like a knife, what is the right strategy to deploy the funds? Should the investments be staggered across dips, or how can one decide the timings and the quantity for each phase? Like currently, it's happening since 1 year.
Yeah, I don't think you can ever time the market. It's a myth. For people that have done it or claim to have done it, good luck to them. The way I look at it is very simple. Let's go back to an earlier question you asked about a potential multi-bagger. Now, let's say if a stock is, for argument's sake, 500 rupees, and I think that that stock is probably going to go and become 1,000 rupees, all right? Maybe over 2 years, 3 years, whatever is the time frame. I don't have to catch it at 500 and sell it at 1,000. There are no prices for that, right? Uh, if I am not somebody who's invested directly in the market or has real-time information, even if I buy the stock after it's gone up 15, 20% and I sell it 20% off the high and I've made 60% in the middle, what's the harm? I mean, a 60% return or even a 50% return on the stock is a phenomenal return. It's multiple times what any other asset classes will give you in a protracted period of time. Of course, gold and silver notwithstanding of what we've seen of late. But I think, this entire issue of timing the market is a myth. It may exist. Like I said, there may be people out there who do it. There may be quantitative based strategies, hedge funds, etc., that are able to do it, but it's not an area I have an expertise in. And it's not something that I would advise your young audience to even try and do. Uh, I don't think there are definitive signs of when you can call a market top or a bottom. I think, let me just take you back to a couple of months. When the Nifty was at 26, 27,000, I think it was a consensus in the market that the Nifty didn't deserve to be there. Obviously, nobody thought the Iran war will happen and therefore the Nifty would come down to 22,000, but the market was ready for a correction. This just became an excuse for a correction. That had the war not happened, maybe the trigger could have been the quarterly results. Maybe it could have been something else. I don't know. But the market was anyway primed for a correction. So there are certain signals that you do get on valuations that the market is getting overheated. And at that point in time, either you move it to other asset classes, like I said, or you can even sit on cash. There is nothing to say that you have to be invested at all points in time. If you have 100 rupees to invest and you're keeping 30, 40 rupees of that as cash at some point in time because you want to buy into a better asset class at what you think is a better time, that's perfectly good strategy as well. It's an unproductive way to utilize your money, but sometimes just keeping cash is also relative outperformance if the index is going down. So I personally think it's a fictional exercise to try and figure out when the market bottoms and when it tops. But like I said, when valuations give you a signal that the market is hitting a top, valuation will give you a signal when the market is approaching a reasonable level as well. So let's say, for example, I'll just give you an example of an IT services, of the IT services sector. Some of the frontline IT companies were trading before this war started at say 23, 24 times 1 year forward. These have come down post Anthropic and a lot of the other data points around AI and then of course the subsequent war. These have come down to about say 15, 14, 15, 16 times. Now, obviously, I know that these companies are not going to go into single digit valuation. So the market is automatically telling me that I can, go in and start buying these stocks. Could they fall another 10% from there? Sure, they can. But then, as you said, you start using a concept of dollar cost averaging. And if you are convinced that this stock is going to rise, even if it falls another 10%, average out. Because if you're convinced a stock is going to go up 40% and after you buy, it goes down 10%, you're still up 30% on a relative basis between the, fall and the fact that it rises from there. So you may think you have bought a stock at 100 rupees, it's going to 140. It may go to 90 and rise to 130. Big deal. I've still made my money and it's still a very good 3:1 trade off for a trade taken. So that's the way I would look at it. Don't try and time the top and bottom. Valuations will give you the signal. And like I said, in the current construct, if you have a situation where the rupee comes down to say 89, 88, 89 rupees, if you have crude down to say 70, 80, inflation under check, if the monsoons are expected to be normal, that's your trigger. The market has probably bottomed out if there is no more, noise on the geopolitical front. So you will get these signals from time to time, but I think valuations, at least for a top, are a very, very good indicator. The reasons will always follow. Now you can argue that the Nifty should not have fallen 4,000, 5,000 points. Maybe, if it had fallen just on valuation, it may have fallen 2,000, 3,000 points. It may have exacerbated because of the war, but then of course there are other aspects of the economy that the war has opened up, whether it's rupee, crude, raw material costs, etc., etc. So that's broadly the way I look at things.
So when it comes to profit booking and capital withdrawal from these kind of market scenarios, even the retail investor get panic and they start withdrawing cash. So what kind of tactical or a strategical adjustment do you make in your client's portfolio? And how do you decide the right time to shift allocation towards safer sides like debt or a gold?
See, this is a very difficult question to answer on when to sell a stock because what happens is, let's go back to the example I gave you, right? So let's say that 100 rupee stock, you were expecting it to go to 140, it went down to 90, it hits 130. Now, let's say that 130 becomes 140, right? In your mind, you were already waiting for 140, it's come. That 140 becomes 160, could even become 180. But then something happens, and then that 180 becomes, say, 120 again. So it's very difficult to time when to exit a stock. But the way I look at it is, if you have an expected return from a stock, it's a good time to exit. Nobody has ever timed, an exit perfectly. I know, for example, an investor who bought Indian hotels coming out of the lockdown at 100 rupees. I think the stock hit a low of about 50 or 60 or 70 rupees, something like that. And they bought it at 100 rupees. And this is a fund manager, and they sold it at about 500, 550. Right, this is a fund manager. That stock eventually went down to, I think, 900 or 1,000 rupees. It practically doubled from where he sold it. So he had already made 5x his money. Now, would you say he's a bad timer of the market? I don't think so, because you've already made 5x the money. These are all, right? And let's take that same example forward, right? Let's say you bought the stock at, theoretically, let's say you bought it at 500 rupees, Indian hotels. The stock did go to 1,000, right? Let's say you doubled your money, but you didn't sell. लालच आ गया, आपको लगा कि 1,000 का 1,500 हो जाएगा. The Iran war hit and the stock is back down to 550, 600. You understand? So I think you should, the simple question to ask yourself is, if you are holding a stock where greed has taken over, sell it. It's a simple one line answer. And if you feel you're still holding on to it for value, then keep it. But if you're holding on to it in hope that it'll go higher or greed has taken over, sell it.
Okay. So that means it is very difficult to predict when to exit or do profit booking. It depends upon the individual and what are the personal
Not
goals.
really, actually. I think if you look at valuations, right? So
Okay.
valuations are a good indicator, right? So let's say, you bought a stock. Let's say, for example, let's go back to IT services. Let's say you bought an IT company today at 15x multiple. Let's say it has a good run and goes to a 25x multiple, right? Let's say that 25 becomes 27, right? It is gone above average, right? You have historical P's. Now you relate that to growth. Right. And if you see that the price to earnings multiple is now going into a situation where growth is not supporting it, it's a trigger to sell. So it's not that hard to sell. It's just that when greed takes over, then you put reason to rest. And that's where a lot of people find it difficult to exit. And that's why you find that a lot of people who say, अरे यार इस पैसे स्टॉक ने तो अच्छा किया पैसे गवा दिए, they had a chance to exit but they didn't exit. Right. And all of us have learned this lesson. I think every investor that you speak to, the most savvy of them, would have lost money on some investment or the other and learned this the hard way, including the late Rakesh Jhunjhunwala. I can assure you of that because, in what happens in media is we always highlight the success stories. We never highlight the failures or the calls that have gone wrong. But we all learn by making mistakes. And, even if it's, the young generation coming up, which may be predominantly your audience, I would encourage them to make mistakes. Don't be shy of making mistakes because that will make you a better professional going forward. You will know what not to do. If I lose, say, 5 lakh rupees on a trade today, as a medium-sized investor, or it could be a very large investor who's lost 5 crores on a particular transaction. Imagine the learnings that you come out of that. You may well recover that money, and most people do in other stocks as well. But that learning has to stay with you for life. So I don't think that exiting a stock is a very hard thing to do. You just have to read the signs on the wall and not get too greedy.
Yeah. There is a lot of trend going on of some sectors like the emerging sectors like AI, water recycling, EV, and semiconductors. So, according to you, what should be the new emerging sectors? I mean, are these the only one, or there are some more list ahead?
No, I think these are pretty much the only ones because, and you can add AI and data centers to it, GCCs to it. Now, these are not themes that have just evaporated. These are themes that have just emerged in the last 2, 3, 4 years. So these are themes that are going to become very, very big over the next 20, 25 years. So I don't think you're going to get into a situation where newer and newer themes are going to emerge. These are pretty much going to be the themes that we have just discussed in the last 45 seconds. There may not be too many direct ways to play them through Indian listed players. You could find proxies or direct investments in the overseas market for people who are invested in this. Like I said, you are allowed a certain amount of investments overseas, but you could find proxies, raw material suppliers, end users. I mean, there are ways to play proxies to these as Indian companies emerge. I think it's very possible over the next 5 or 10 years, a lot of companies that we don't know today will come in and list that have something to do with these entities, right? When the platform companies started coming in, we had a tsunami of them, right? Post 2020, whether it was a Policy Bazaar, Paytm, Nykaa, Swiggy, Zomato. The list is quite endless of the number of platform companies that came in and still are coming out to this day. So I think that the broad themes for the market in terms of new ones would remain what you and I have just discussed in this segment. But I think there are not too many direct listed equity names to play these through. There will be a handful. There could be 20, 30, 40 stocks that may be, directly or indirectly associated, but you probably have to find proxies, suppliers, end users, ancillaries, that have something to do with the main players in these lines of businesses till actual authentic players in these line of businesses actually come in and list.
As we have talked about the emerging sectors like AI, water recycling, and all. So, how much should be the allocation in portfolio? When we talk about the portfolio construction, we see that banking, financials, care, FMCG, these should be in the major proportion. So, for considering these emerging sectors, how much should be the proportion, and which sectors, according to you, should be kept in the portfolio, and how much percentage?
So, like I said, I don't think that there are too many. You can't have a very large exposure to these sunrise sectors because, like I said, there is not any, there is no major way to play these at this point in time. I think if I was still making a portfolio in India today, I would still tag it to what the benchmark index was. I think 40% of my exposure would still be to banks. I think credit growth is now up to 13, 14%. Had this issue not happened and FPI is not sold, there was a good chance that the Nifty could have been 10% higher, before this correction started, which means the Nifty could have been at 28, 29,000, sort of driven by banks. So I think banks is one where I think earnings growth looks all right. Of course, because of this war and the LPG shortages and things like that, there are going to be short-term concerns over the next 3 to 6 months. But had this not happened, I think banks would have been a clear overweight. And I think credit growth has returned. So that's one sector. IT as a contrarian could be an interesting place to put some money in. I think consumer discretionary stocks are doing all right. And I think they may continue to do well, which is the premium end of pretty much every portfolio. And another sunrise sector, it's not necessarily a sunrise sector, but I think it has got prominence over the last 4 or 5 years or less, has been defense in India. And I think the kind of orders that are being, awarded and the kind of export potential that some of our defense companies have, that could also be an interesting play. So I think between these, I think it's not a bad portfolio to build. I think auto is also one place where the traction has been good and could potentially continue to be good. I think these would be the sectors where I would look at concentrating my investments in at this point.
Thank you so much for giving your valuable time, sir. We have covered a lot today and hope to see you soon in the next session. So,
Thank you
thank
so
you
much
so
for
much
having
for,
me, Ashley. Wish you all the
yeah,
best.
thank you so much.
Thank you.